You may well have a portfolio of direct shares, but you could also consider investment trusts for your portfolio. Investment trusts are companies that invest in a diversified portfolio of assets to make money for their shareholders. They are listed on a stock exchange and allow you to gain exposure at low cost to a diversified, professionally run portfolio, spreading the risk of your investment. In terms of your portfolio, all investment trusts have a specific objective: long-term capital growth, generating an income, or a combination of capital growth and income. So some of their common investment uses include long-term saving for the future, generating an income, perhaps for retirement, or saving for children or school fees. Investment trusts cover a wide range of sectors, and this allows you to diversify your portfolio. They range from the more traditional UK and global sectors to the more exotic emerging markets, Far East, alternative energy and unquoted company. So there's a vast range of choice to spice up your portfolio. Well, we've seen a busy year for the investment trust sector, 17 new launches in total. Interestingly, around a third of these have been in the hedge fund sector. The investment trust sector is really the only way private investors can get access to hedge funds, either through a fund of funds or a single manager hedge fund. But there have also been a number of private equity launches, giving investors access to unquoted companies, and infrastructure launches. So most launches have been in alternative assets this year. Well, investment trusts are closed-ended. There are a fixed number of shares in issue. So the good news is that managers can ride out periods of volatility without having to sell their best stock to meet redemptions. In the investment trust industry, investor sentiment and demand is measured by the discount, the difference between the share price and the underlying value of the fund. So this year, as the markets have got more turbulent, the average discount for the sector has increased from 5% in January to 10% on November the 21st. But this very much varies from sector to sector and trust to trust. Discounts can represent a buying opportunity, but you should never assume this and buy on the discount alone, as it is very important to do your homework to understand the company before investing. When markets are volatile, investors should consider regular saving each month. This works due to pound cost averaging, so when markets are low, you buy more shares, and when markets are high, you buy less shares. If markets are volatile, this works very well and gives you a lower risk profile. Of course, if you time your lump sum investment at the bottom of the market, you will outperform regular saving, but that's never easy. And professional investors usually drip feed money into the market when they think there is a buying opportunity. So why not follow their example? Well, the credit crunch looks set to continue into 2008, and the impact could continue to spread from the financial sector to the consumer, so it could be a challenging year. Managers have switched to blue chips as they are more resilient to market volatility, and I think that's likely to continue. In terms of investment trends, we've already seen launches of a number of funds investing in Africa, and I think we're likely to see more next year. There are lots of investment opportunities. For example, the next World Cup is in South Africa, which is going to encourage a lot of infrastructure investment.